Start on provisions for bad loans. Clearly, they've fallen significantly from the last quarter, which is encouraging. How are you feeling about the strength of the consumer? And as you look across the loan book, which parts of it are contributing to an improved outlook versus still a little bit worrying?
Sure. I think credits were a lot more constructive at the end of the third quarter versus what we knew at the end of the second quarter when we put up a big provision. So this quarter, our credit costs really are just the charge-offs that have come through. We didn't meaningfully build the reserve at all. Part of what's contributing to that on the consumer side is certainly there's some stimulus, which means more consumers have liquidity available while that runs its course. And then lots of banks, including Wells Fargo, have created deferral programs where people have been able to take a break in making what would otherwise be required payments on mortgages, credit cards, and autos. Most of those things have subsided and we're way down, and the performance has been good as people have come out of those. But it won't be until the first half of next year when we know what the unemployment picture is, what the liquidity picture is for consumers, and what charge-offs will be. But it feels better today than it did 3 months ago, and the results have been better in the last 3 months than were previously predicted. On the business side, there are some specific areas in commercial real estate, specific areas in retail, in energy, and transportation that have been obviously hard hit by the pandemic. I think we've accounted for those in our own allowance process in terms of building reserves. And again, the realized outcomes have been better than predicted so far. So there's still a lot to learn about the virus and what happens to the economy and what happens to businesses. But it feels better today than it did 3 months ago for sure.
Do you think this quarter will mark the low for net interest income?
Oh, it's tough to say. It depends on loan growth. I think you mentioned in an earlier segment that at least we have been talking about commercial loan growth. Because the capital markets are so wide open, borrowers are relying less on their banks. And then we've got certain categories in the middle market of commercial customers who are carrying very low inventory and thus borrowing less to support that inventory. So commercial loans are just much lower than they might otherwise be. And, of course, we're in the middle of a pandemic, so borrowers are probably operating with a little bit more of a risk awareness. So higher commercial loan balance would mean higher net interest income, and that, for us, is probably a swing item between this quarter and the next couple of quarters. On the consumer side, there's still lots of mortgages being originated, and loan growth or borrower demand is strong there. Credit cards, a little bit less so, but it's improving. People have been more reluctant to spend on their credit cards during the pandemic, although that is improving a little bit. And then people are buying cars, so there's plenty of loan growth possible in the auto business.
Shepard Smith here. Thanks for watching CNBC on YouTube.